Hello, hello. I think we're live now. I
Yeah.
think we'll just give it a few seconds for everyone to tune in.
How do we know who's attending?
We have the list. Maybe there would be a report afterwards about who has attended, but we have a list of all the registrations.
Okay, so people can see and
Yes,
who. But
yes.
can they ask questions or no?
No.
Uh,
No. No. That's
I
good.
think we can make someone a speaker on LinkedIn, if I'm not mistaken.
Uh, on LinkedIn, we can only from the third party tool, but then they need to be invited. Yani the
Okay.
same link that I sent to you guys, and we would need to send it to them. Um,
Okay. I think we have a few attendees, so let's go ahead and start, Hisham. Meanwhile, we'll figure this out on the go. كل ما حد يدخل. بس such a pleasure to have you, Hisham. يعني all of us, I think اليوم we're proving no matter where we go in tech, we're still improving day by day.
Right. Yeah. Yeah.
طيب بسم الله الرحمن الرحيم. It's such a pleasure to have you here, Hisham. Thank you so much for joining us. يعني you've been and you will always be a core partner with Falak Angels, Kassim Legal, you personally as well. From the amount of information we've learned from you on legal, قلنا why don't we put everything together for us to share the knowledge with all of the founders out there, all of the investors as well, on core legal infrastructures for founders and investors. Before we start anything, I'd love to have an intro منك. Tell us about Qasim Legal and about yourself as well.
Yeah, sure. Thank you so much for having me, Adwa. As Adwa mentioned, we are big fans of Adwa AlDakheel and Falak Angels and the great work that they're doing in Saudi. My name is Hisham Kassim. I'm the managing partner of Kassim Legal. We're a venture boutique. We only work in venture, whether for startups or venture funds or angel investors. I think this is our fifth or sixth webinar together with Falak Angels. And yes, we are working out the tech as we speak. And thank you again for having me.
Great. Hisham, I know you're always humble. ولكن I would love for you for 5 seconds to not be humble and tell our audience on your previous experiences on working with startups, scale-ups, M&A as well, and VC.
Okay, so we've been doing the same thing for about 15 years. So we've been in the venture space about 15 years. I think we've closed over 200 or 300 M&A transactions. We've represented over 200 startups. I think we've reached the 50 mark on venture funds. After a certain point, you just start counting, you stop counting. But yeah, I mean, everything from seed to Series A, B, C, D, all the way up to pre-IPO. We've also done a few exits, and so I think the idea is that we do one thing and we do it really well. You stop counting.
يمكن من هنا I would love to start off and one of the first questions on a shock factor. So the first shock factor that I would love to know, what is the craziest legal story or legal standing that you faced in your role as a legal advisor with either growth stage companies or early stage companies?
It would probably, we get hired sometimes by venture funds to do due diligence on companies. So that's usually, luckily, we're very lucky. Most startups are, they usually adhere to all the rules and there's no funny business with their financials. But every now and then we get a very special startup that has all the red flags. This happens once every 3 or 4 years, we get someone like this. And that's usually, you can write movies about this, on how they mismanage funds, or I don't know if I can get into too much detail, but basically it's the pattern we see with startups is they're either law abiding with some mistakes, but usually very, very innocent. And then you sort of have the other section, which is they don't abide by anything. So I think that's probably the main pattern that we see. We don't see anyone in the middle.
Yeah, I feel like this is maybe partially, and in احنا as Falak as well, we've seen founders that get, I don't want to say scammed, but I can't think of a nicer word, that get
Right.
played with, I would say, with other co-founders. We see founders that get يعني also very bad terms from VCs, and we see also VCs or angel investors that are starting off their angel investment يعني portfolio, that also get يعني on the bad of the legal standing. So I feel like everyone in this ecosystem has faced one case or another with like a shocking example.
Yeah.
يمكن I think this is where the main premise of today is for us to share with all of our attendees, whether founders, investors, حتى professionals thinking of starting their angel investment career, on what to look out for in legal flags. So ممكن if we dive in deeper, يعني أنت as a legal advisor هشام, what would be the first item لو جاك اليوم a founder قال لك I want to raise my Series A? What would be the first few items that you would make sure they're incorporated in their legal documents?
Right. So let's say I'm an angel investor. Someone comes in and says, I want to invest, I'm raising my Series A or seed round or whatever it is, and I want you to invest in my company. First thing from a legal perspective is we ask for a data room, right? It's a very generic sort of VDR, which is an online folder somewhere. That tells us probably 90% of what we need to know. If they have one, if they know what it is, if it's organized, if it's numbered, that will tell us right away that they're serious, that they have nothing to hide, that they're probably not in the second category of startups, the one that's looking out to scam you. So we usually start with the data room. It doesn't have to be super organized or numbered in a certain way, but it does need to be somewhere easily accessible. If another thing we look out for is if a founder says, I need you to sign an NDA, or I need you to sign an LOI, or I need you to sign X, before you've had a chance to look at their data room. The norm in venture is we don't sign NDAs or LOIs before we take a look at your data room, at least an initial look. Later on, if you want to give us very confidential or sensitive information, but that's sort of round 2. But at least the initial screening needs to be shared openly with the investors. So any founder that says, oh, it's secret, or, oh, I don't have one, or I am in the process, that's sort of what we look for. How readily accessible are they, or how willing are they to give you access to their documents? That's step 1, right?
Data room.
Yeah, the data room. And then okay. Sorry, go ahead.
لا I just wanted to pin that لأنه later I'll be asking you على must haves of the data room for all founders and angel investors to look out for.
Right.
بس كمل. Second.
Yeah. So the second, then we start looking at the actual documents. We're looking for 3 things: who they are, so where the company registration documents, its licenses, if it has licenses, who are their employees, and then what is it that they do. So if they're a software company, there's not much from a legal perspective, other than making sure that they have software engineers or they have tech people. And we look at customers and suppliers. So those are the four main pieces of doing any kind of due diligence. I'll stop here.
In customers and suppliers, I would assume here what you're looking for is the credibility of the information that the founder has shared. If they're saying, Wallah, we have $100,000 ARR, you want to ensure that these are contracts that are valid and that are not just fluff, right?
Right. They're not just a bunch of bots somewhere. We're screening for revenue concentration. So luckily, most startups don't have this issue. But if they have one or two clients that make up 50% of their revenue, that's very high risk for any investor. If they lose that contract, then they lose 50% of their revenue. For suppliers, we look for those with the funny names, we call it. So if it's Google, AWS, Emirates, world-known, well-known brands, we don't usually look too deep into that unless the amount is very, very high. It's for suppliers that are individuals or unknown companies that are being paid, and we're not entirely sure what the company is getting. So that's usually, this is usually where most of the fraud is. It's paying suppliers with the funny names. That's the easy way to remember it. So if you have Abu Musa's falafel shop getting 500 a month, we want to know why this guy's getting 500 a month. Sorry, go ahead.
You made me crave falafels. Allah yahdik, Hisham. I think after this call, I'll go and get some falafels. But this is a really valid point because especially, I remember, I think it was last year, we were looking at a logistics technology company. And you have a lot of Abu Musa's falafels over there, especially in contractors. And when we were looking at their VDR, I think it was around a year and a half ago, 2 years. When we were looking at their VDR, their numbers were incredible. But when we went to the suppliers and contractors as a core part of the VDR, we realized that the majority of the contracts, more than 95%, were actually coming from the contractor company of the father of the entrepreneur. So we started understanding that less than 5% of what we're looking at in terms of revenue is actual revenue that is from the product itself and not from other family businesses that they're attributing to this company just to inflate the revenues and the valuations. This is an extremely valid point. Is diving deeper on the names, the resources, who are the clients, what are the contracts, what's the relationship between the founder and the clients that they're saying that they have, and what's the credibility of the standing of that supplier/vendor relationship.
Yeah, exactly. I mean, we tell investors this: don't be ashamed of asking for financials. We usually ask for bank statements. We don't even rely on financials. We want to see money coming in on a consistent basis and money going out. And then we usually go through the bank statements to see if there are any weird payments, cash withdrawals, big cash withdrawals, any transfers between related accounts, right? So usually bank statements will tell you a lot about the financial condition of a company, and it's
100%.
Yeah.
Definitely. So you said a data room, and then you said inside the data room is supplier contracts, client contracts. What are the other must-haves of the startup data room that every investor should be aware of?
Also, if you're there, so we start with the who. So the who are the founders. First, there needs to be contract for the founders. If there's more than one, please only invest in companies that have at least two. Having a startup is a very difficult job, and doing it on your own is even more difficult. So most venture funds, most investors like to see at least two founders, and two founders with special skill sets. So with the who, we want to make sure there's two or three or four, however, hopefully not more than four. And that each one has a role. And usually you can tell as an investor who, if they have their agreement done, if you sit in a meeting with them and you ask a question, and everyone, all the founders, look to the person that has the answer. This means they've divided up their roles. So you can't have two salespeople or two tech people. Their roles should be complementary. Otherwise, it creates conflict. So that would probably be the first part of the who they are. And then they need to have an agreement for who does what, who's in charge of the money, who's in charge of paying the bills, who's going to buy the coffee, who's going to bring in the clients. That it doesn't have to be very formal. They don't need a 50-page agreement. It could be a 3-page MOU between them that says, these are our roles, this is how we work together, these are the decisions, we need 2 out of 3, and these are the decisions, we need 3 out of 3. But there needs to be some organization.
If you would allow me here, Hisham,
Yeah.
I was checking something with the data of Y Combinator. Y Combinator, for anyone tuning in that doesn't know, is the #1 investment-backed accelerator in the world. Amongst their graduates are Dropbox, Airbnb, a lot of stellar companies. يعني حتى amongst our Saudi startups, actually, شركة الدراهم was also one of the graduates of Y Combinator. In their portfolio, they have more than 2,000 plus startups. And they did a really fascinating study. And I think if you guys follow them on Instagram, you'll see a few snippets of the video that they've shot as well with the founders. Is what was the most common reason that the Y Combinator startups failed, and that common reason was co-founder issues. So when you talk about the who, and I love how you said it, is genuinely humans are made of النفس, right? يعني ego. They're made of a lot of things that are not just black or white. They're made of a lot of those gray elements. And when it's ideation and you're starting off a company and things are beautiful, and you're just that ambitious founder, you're great with your co-founder. But once success or failure starts happening, that's when you see the true colors. And I feel like having that in advance, like stating the roles of what happens when that success happens, what happens when failures happen, who's in charge of what, so accountability is out there as well. I can't stress that enough. We've seen it with multiple founders. I've faced this as well as a founder myself. It cannot be exaggerated. It's extremely important, not just for the investor in data room, but also for complete understanding between the founding team members, is what is required for each and what's expected for each.
Right. Yeah. So if I were an investor,
this is the who.
Sorry. No. I was going to give an example of what investors can do. So if I were an investor and company had three founders, one easy way to check this is to interview each one separately and ask them, what is your role here? A good startup, everyone would say what their role is without the other two guys there. But you start running into issues when one or two of them start telling you about a role that is much more expanded than what the other two co-founders know or what the other two co-founders think. So that's usually an easy way to check if there's an alignment between the founders.
I love this. This is like very محقق Conan. يعني it's very
Yeah.
I love this because it gives the complete transparency, and it also shows that the investor is also willing to spend time with each founder individually to also help the founding team have better governance or have better roles and responsibilities as well.
Yeah.
So this is all on the who, Hisham, right? And you mentioned the founding agreements, shareholder agreements as well, I would assume, probably maybe also ESOP agreements. What would be the other elements of a data room?
Data room. So the who are your shareholder agreements, founder agreements. So if people have alignment, then writing these contracts is very easy. All the contracts do is they write out what people have already agreed to. The other part is the what. So if you are selling an app or if you are a marketplace, as an investor, you test it, you log on, you try to buy or try their service, right? So you try to pay using the credit card. So you actually pretend to be, or you don't pretend, you actually go through the customer journey. So the what is verifying what it is that they're selling or service that they're offering. And the best way to do that is, yes, in addition to the legal part, is also you as the investor trying it out for yourself. Luckily, most startups are an e-commerce or they're selling an app or a SaaS. So there's very little legal documentation needed here. The most important one would be making sure that the tech belongs to the company. So big red flag is if startup has outsourced all its tech to a company somewhere else. Startups need to have their own in-house tech teams. This doesn't mean when they're starting out and they're having a beta version that they hired some guy off Fiverr to do it for them. But tech startups need to have in-house tech expertise. So that's probably the most important legal part of what it is that they're selling. This changes, right? If you're selling actual goods, then you have insurance issues, especially if it's like consumer goods. But for the most part, everyone listening is in some type of software, so we don't have those issues.
I love that you mentioned this because so we have the most common best practice on that note, and this is where I would love to get your insights, Hisham. But it's at least what we always urge our founders to do is to have an IP consignment letter where all founders and the founding team relinquish all rights to the software, IP, everything for the company. Is that the best practice legally?
Yeah, it is. They have to sign. It's either in their employment or it could be a separate agreement that says everything I create related to the business of the company belongs to the company. This is because that's really the only asset the startup has is the IP.
Yes.
If you're in B2C, we add another layer, which is the name and trade dress and logo. In B2C, it's very important for the startup to have a good name, to have a good domain, because you're dealing with mass market. In B2B, it's less, it's fine. Businesses they have different buying behavior.
Definitely. And I think this, I think it drives the main point as well, which is intellectual property and software patents. Maybe I think because we're seeing an emergence of this, right? Software patents. Like I was looking up Canva the other day, and we read that Canva owns like 93 software patents. It was a crazy number.
Yeah.
And I think still in the MENA region, we don't really have focus on software patents, or I think it's a matter of awareness. I would love your insights on software patents, Hisham, as well. Like,
Yeah.
in the market, what do you advise founders to do, and what do you also advise investors to push for?
Yeah. So I'm going to date myself a little bit. In the dot-com bubble in the early 2000s, there was a mad rush to patent software. This happened about 20 years ago. Everyone with a software went out and patented it. We're seeing a bit of the same rush happening again 25 years later. The generally accepted belief among most legal practitioners is that you shouldn't patent software, especially if you're a very small company. And the reason is when you patent something, you have to disclose it on a website. So if you patent something in the US, anyone can go, download, see everything for themselves, and they can easily copy it. For the most part, we tell early stage startups, don't patent software. We patent usually devices or pharma goods, but not software. Software patents kick in usually after a company is successful. So if we take, I didn't do this for Canva, but I did do it for Uber, because we had this question about Uber a while back. Was when did Uber file its first patent? And it filed its first patent after Series B. So up until Series B, it was working on something called trade secret. The software was held inside and they didn't disclose it to anyone. After Series B, they had some money. They started filing patents. And I can look at when Canva started filing patents and when. So we will overlay when Canva filed patents and when their financing rounds were. Generally, patent filing is not a growth strategy, it's a exclusion. It's to protect you from failures, to exclude people. So we can do that actually. We can,
And it's
yeah. Canva versus financials. I didn't do it for Canva. Yeah. Sorry.
but
Go ahead.
if you have a write-up around Uber and their Series B,
Yeah.
like initiation of the patent filing, that would be a great read. If you can share it with us, we'd love to also share it with our investors, because
Yeah.
I feel like there's this misconception also with investors, right? Because I think new angel investors going into software or going into tech in general, they want something tangible, and I feel like this is what most of us are always used to. So in their opinion, and the stereotype is that that tangible item is a patent.
Right. But patents are very expensive. And you just gave your secret sauce to everyone because it goes online. So especially we're just talking about in the early stages, like pre-Series A, let's say. You hold everything secret. You don't patent. You try not to patent anything, unless you're in an industry like pharma. Pharma expect patents, but in software, there's really no reason to patent them. It's actually, especially if you're in B2C, the domain name is actually very, very important because it helps people. That's sort of where your address is. But in terms of
Yes,
software patents, it takes a while. It takes about a year to do in the US to file a patent. So if you have $500,000, do you want to spend 30,000-40,000 on a patent, or you want
don't
to spend, right? You also have to allocate the resources that you have.
definitely, and I feel like this is the primary message for all of our early stage founders: is if you're early stage, an IP consignment agreement or letter is more than enough for the current stage that you're in your data room. And this is what can protect, like all intellectual property belongs to the company and not to any individuals.
Right. Exactly. Yeah.
It's funny that you mentioned Uber. I remember there was this crazy story that, sorry, I don't think it was Uber. I think it was WeWork.
WeWork.
Adam Newman, the famous
Yes.
story that Adam, as an individual, he owned the WeWork brand,
Right.
right? And it didn't belong to the company. And then when investors started flooding money, he ended up selling it to the company for like millions. But
Yeah.
yes, definitely. So this is what IP consignment is. So
Yeah.
we touched upon the who, we touched upon right now as well, which is the IP. Are there any other items for the data room for any early stage or even growth stage founders that you deem extremely important to have?
Yeah. So we have any special licenses. So if you're, this really applies to logistics and fintech mostly. You need special licenses either from the central bank or the monetary authority. But if you're not in logistics or fintech, there's usually no additional licenses. The other part is we look at customers, which we already talked about, and suppliers with funny names. It's funny you mention WeWork. So that transaction where he is a founder of WeWork and he owns the IP, this is the kind of weird transaction we don't like to see because he's on both sides. He's the seller and the buyer. So there's a conflict of interest. As much as just for founders to be cognizant of that. So if you own the office and you want to rent it to your startup, make sure it's the market rate. Or make sure it's below market, right? Because a lot of startups do that. The founder has an extra office, they give it out for free. But if you are going to charge, make sure it's at least market.
Yes,
Yeah.
and I
Yeah.
think over here where
Yeah.
you mentioned something that I think is a discussion amongst all founders, or especially early stage founders, is that most early stage founders bootstrapping, they either get discounted salaries or no salary at all.
Right.
Like in the first few years of starting the company, up until the company is stable, they relinquish all rights. Legally
Right.
speaking, what, and also optically speaking, what would be the founder's rights in that case? To
Right.
either compensate for the lack of salaries or to correct it eventually.
Right. So we tell founders to always pay yourself, at least on the books. Always put a salary for yourself. Even if the company doesn't have the money to pay you, put a reasonable salary for yourself. It depends in which country you're in, but you're not going to get paid like you are if you worked at a bank or something, but something to cover your expenses, especially if you have a family. And then as the company makes money, the unpaid salary becomes a debt, becomes a liability on the company that it actually owes you. But it's very important for founders. A lot of founders forget to do this, to at least book your salary. Let's say it's $1,000 a month, to at least say in your business plan and your projections, everything, there has to be a salary. Again, not a very big salary, but there has to be a salary for the founders. No one is expecting you. Your rent isn't free. Your food isn't, you have to pay to live.
Definitely. You made me for a case we got. This was back in 2023, I think. We got a case with these ex corporate founders. So they resigned from their corporate, extremely well paying jobs to start the company, and the company was idea stage. And when we looked at the use of proceeds for their fundraise, the use of proceeds was, I would say, more than 80% to cover the founder salaries, and this was for their pre-seed round. Like they were two co-founders. والحق ينقال يعني they were extremely smart co-founders يعني extremely, but they were 80% of the use of proceeds in a pre-seed round to cover salaries per individual of like 70,000 riyals. This was my red flag, is that you want someone to invest in the company. Where's your own investment? And I think this is where we opted out of the deal. Eventually, they became extremely successful, mashallah, tabarakallah, and I kind of regret not investing, but it was a matter. It was a matter of principle that we saw, right? So, what's your opinion on this? Like, right now, salaries, especially in Riyadh, are extremely inflated, and we know that there's this like deficit of very high talent. What's your insights on this?
I think if you're going to start up, you're going to take a pay cut from your day job. There's two types of compensation. One is you're working on your own, which study after study shows people are happier and more engaged when it's their own company. And you own equity in the company. So if you're one of the co-founders, maybe you own 30, 40, 50%. But the idea of having very lucrative salary early on, that should not be the motive. The motive should be, I need a salary to cover my expenses wherever you are in life. And the rest you'll either make later as equity appreciation or in your exit. The other point was that there's lack of good startups. I don't think we have a lack of talent. I think we have great talent, but we need to push more people away from salaried jobs and maybe towards more entrepreneurship and a bit more risk taking. And that's part of the ecosystem that we're trying to build in MENA, right? Accelerators and incubators and venture builders now. I think there are a few venture builders running around trying to generate more pipeline or more startups.
Yes,
I'm looking at the comments. Sorry.
I'm coming to the comments, but I think I just want to finalize a data room. So, any final notes on a data room? Because I think we have a lot of early stage founders. We have a lot of existing investors and aspiring investors as well. So I think we're talking about the must-haves of a data room, which I think you have covered. You have the primary topic of our session today, which is how to legally protect your investments.
Right. Yeah.
Any final thoughts on a data room?
You have to trust the founder. If you don't trust the founder, no contract is going to save you. So it's all the little things. The founder says, I'm going to send you my deck at 5, and they send you their deck at 5. So that's every interaction you have with the founder. They should be depositing in the trust. They should be building trust with you. So just keep that in mind. The human element is probably the most important thing in venture investing, because you're basically investing in the people, especially early stage. There's no product, there's no revenue, there's no customers. And the one final thing is, as investors, don't be alarmed if the startup needs to change its pricing model, it needs to change its offering, so good founders will test. They'll test something 1 month, 2 months, they'll get data and they'll keep iterating. I think that's it.
Yeah, I love that you mentioned that. And I completely second this.
Yeah.
All right, so let's go to the chat since we have around 5 minutes. So we have, first of all, welcome. Silent Trigger, I see that you're talking about the company on the chat. Welcome as well, Wellpreneur. I hope I'm pronouncing it right. All of our attendees, we're very happy to have you, and we can't wait to see you become investable pipeline as well for investors out there. So I think the first question is in regards to taxation in investment contracts, whether this is upon exit or even something for angel investors to take into account when they're first investing into a company with the jurisdiction as well.
Right. So most investments in startups are you're not investing for a steady return. So this is maybe the main thing to keep in mind. It's not a bond or a coupon. It doesn't pay 6% every year. You're putting in money usually for 3, 4, 5, 6 years, and you're hoping that this money will quadruple or quintuple in that amount of time. This type of payment where you put in, let's say, 10,000 and it comes back to you as 50,000 is called capital gains. It's not interest or profit distribution. Capital gains in most jurisdictions like ADGM or Cayman, and even in the US, if you're not a US citizen, is tax exempt or not tax. There's no tax on capital gains. So again, this is a very general statement, but most countries don't like to touch or tax capital gains. They like to tax predictable income. But for most of you, no startup should be distributing profits every year.
Noted. So maybe here is to look at the jurisdictions that allow you to have tax-friendly clauses. And if
Right.
you're not a U.S. citizen, in that case, if you're not from the nationality of the offshore jurisdiction, what is something to keep into account when it comes to taxation upon exit?
So if you don't reside, so let's say you invest in a Cayman company or an ADGM company, because that's very popular in Saudi. If you exit from an ADGM company, there's usually no requirement to file anything in that jurisdiction, so long as you're not a resident or citizen of that jurisdiction. So most startups, I'm sure you all know, register in a handful of places like Cayman, ADGM, BVI, the US. They pick those jurisdictions because venture funds are familiar with them and they tend to have good tax treatment on capital gains.
Beautiful.
Yeah.
And from the founders, because this is one of the most common questions we get as Falak as well. But I'd love to get your insights on this. When should a founder invest in? Sorry, I think you're breaking out. Can you hear me?
No. Yeah, I can. Yeah.
So when should a founder invest in establishing a holding company offshore?
Usually with their first serious ticket from a venture fund. So they're early stage. I know most accelerators in Saudi, you don't need to register in ADGM or Cayman. You can just register in Saudi. That's perfectly fine. But usually when you get your first serious investment of, let's say, $250,000 or more, that's usually when the flip happens, when startups start thinking of, I need to register a holding company, I need to formalize. Remember that MOU we discussed, the agreement between the founders, that usually gets written out into a full-blown shareholder agreement around this time also. They have some extra money, basically, to start formalizing.
Beautiful.
Yeah.
Okay, I think I'm just worried that this software will kick us out in 1 minute. But inshallah, I won't. So we'll take one more question from the comments, and then we're gonna wrap up. But the question was in regards to sorry, let me just see this. Okay, the question was in regards to founders and the main differences in their fundraise between their seed round and their Series A or Series B round. From a legal standpoint, what are the primary differences between a founder raising their seed or pre-seed and a founder raising their Series A?
At seed or pre-seed, the investment is is the founder. So most VCs invest via SAFE. There's a short side letter, and they're basically making a bet on you. Usually the investment amount isn't very much, but it's enough to get you started and see if your product will actually scale in the market. So the legal documentation is very light. At Series A is you have a product. The investment now is still in you, primarily in you as the founder, but investors are now saying, there could be a product here that could really scale very quickly. and we want to double down. So the legal documentation in Series A is like 10 times longer and more complicated, maybe not 10, maybe 5 times longer and more complicated than a seed and pre-seed. Also, the due diligence between both, there's a factor of 2 or 3, because now they're not just investing in you, they're investing in you and your business. So it goes up, not linear, like it doubles or triples the amount of work that goes between Series Seed and Series A.
Beautiful.
Oh,
So I think, sorry?
Hisham Saleh joined. That's not, yeah, okay. Sorry.
Hisham, I completely agree. He truly is, and this is the primary reasons he's our legal partner in Falak Angels. We're lucky to have you, Hisham.
Thank you. Thank you. It's a real pleasure. Thank you, guys. Thank you, everyone, for joining. Sorry, I always feel bad when we don't get to everyone's questions, but I'm glad we got
But
to
I think,
cover.
mashallah, we covered a lot, and I think anyone as well. I think it's worth noting that Falak Angels and Kassim Legal always collaborate with in like venture capital boot camps, venture class 101, where we dive in deeper into the most common topics for investors and startups as well. So anyone that does not follow our accounts to stay tuned to all of the announcements on the boot camps and learning courses as well. Please make sure you're tuned in to be aware of anything upcoming, inshallah. And I think one primary outcome from today, Hisham, from the engagement we've seen, is that we need to do much more of these sessions.
We do. Yeah.
Definitely. Thank you so much for tuning in. Thank you, Hisham. And thank you to all of our incredible attendees.
Thank you. Take care.
Thank
All right.
You
Bye.
too. Have a great day.
Yeah, you too. Thank you, everyone. Bye.
Thank you.